Alright, so you think Vegas casinos make their billions from slot machines and blackjack tables, right? Wrong. The truth is far more complex, far more sophisticated, and far more profitable than you could possibly imagine. First of all, a modern Las Vegas casino resort can cost anywhere from $500 million to $3 billion to build. That's more than the entire annual budget of some small nations. But here's the strange part. The casino operating the resort usually doesn't own it outright. And more importantly, how does owning a $2 billion gambling empire actually make you money? Because in Las Vegas, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear Las Vegas Casino, they imagine bright lights, slot machines, and people winning big at the tables. But a modern mega resort, like the Bellagio or the Venetian, is essentially a self-sustaining financial machine. It consists of thousands of rooms, hundreds of gaming tables, tens of thousands of slot machines, multiple restaurants, theaters, nightclubs, and shopping centers, all designed with one purpose in mind, extracting maximum value from every single visitor. The architecture itself is engineered to keep people inside, spending money for as long as possible. There are no clocks on the walls. There are no windows showing the outside world. The lighting is carefully controlled to create a sense of timelessness. The music is scientifically selected to influence behavior. Everything is designed to make you lose track of time and money. Take a large casino resort ordered from a major developer, but the prices are not random. It all depends on the location, the size of the property, the quality of the amenities, and the expected gaming revenue. A casino in downtown Las Vegas might cost $500 million. A mega resort on the Strip might cost $3 billion. And then there's global demand for gambling, the ultimate wild card that shapes everything. Casino prices don't behave like real estate. They behave like volatile stocks on steroids. When tourism is booming and gambling is profitable, casino values surge dramatically. During downturns, they collapse with staggering speed. For example, during the economic crisis of 2008, some casino values dropped more than 50% in a single year. Casinos that cost $2 billion to build were suddenly worth $800 million before they even reopened, simply because demand had evaporated overnight. In Las Vegas, there are three main players: the casino developers, the casino operators, and the casino owners. And almost always they're completely separate companies with diverging interests. For example, a global casino operator like MGM Resorts or Caesars Entertainment operates dozens of casinos. You see their logos on the buildings, but they do not own all of those properties. In fact, many casino operators prefer to own as few as possible because ownership is a capital-intensive nightmare. Many are simply leased from distant owners you'll never meet. So who holds the deed to that $2 billion piece of real estate? It might be a real estate investment trust like Vici Properties, which owns thousands of properties across their portfolio. It could be a wealthy individual from the Middle East or Asia who views casino ownership as a long-term investment and status symbol. It might be a pension fund from Scandinavia or Japan, massive financial institutions that buy casinos purely as diversification assets on their balance sheets, or even a private equity firm operating out of a sleek office in New York or London. These owners don't care about customer experience. They don't care about the quality of the shows or the restaurants. They care about one thing: rental income. Owning a casino is basically a massive high-stakes leasing business. To make your money back, you have to lease it out at rates that justify the staggering capital investment. There are three main lease types, each with a vastly different risk profile and income structure. Number one is the long-term lease, a safety bet for owners. Casino operator rents the property for a fixed monthly rate over a specific period, perhaps $50 million per month for 20 years. The owner provides the property, handles major maintenance, and carries insurance. The operator handles gaming, hospitality, and day-to-day operations. If rates are high when you sign, you lock in strong guaranteed returns. But if the market surges right after you sign, you're stuck at the old rate. Number two is the medium-term lease. The casino operator rents the property for 10 to 15 years at a negotiated rate. For the owner, this provides more flexibility to adjust rates as the market changes, but introduces significantly more uncertainty about future returns. The operator gets flexibility to return the property if demand drops unexpectedly. Number three is the short-term lease or management contract. The owner not only provides the property but also provides capital for operations and marketing. For the owner, this is higher income but also higher involvement and risk. For the operator, this is expensive but offers maximum flexibility during crises. This is where the system reveals its true nature with brutal clarity. When COVID-19 hit in 2020, casinos faced an existential crisis. Demand for gambling collapsed overnight as the world locked down. Casinos couldn't afford to keep operating at full capacity, burning money through labor costs and utilities while generating minimal revenue. They desperately negotiated with owners to reduce lease payments, often breaking long-term lease agreements and paying penalties. Suddenly, casino owners found themselves holding massive properties with no one to lease them to. Properties that were generating $50 million per month in lease payments were now generating absolutely zero. Owners faced a difficult choice: accept pennies on the dollar to get the properties off their books, or hold out and hope demand returned. Many chose wrong and went bankrupt themselves. The separation of ownership and operations spreads risk, but it also creates contagion across the entire financial system. When operators fail, owners suffer catastrophic losses that cascade through their portfolios. How do these owners afford the properties in the first place? Because almost no one pays cash. The typical financial structure is 20 to 30% equity and 70 to 80% bank financing. Real estate banks provide colossal loans secured by the property itself as collateral. To protect themselves from catastrophic losses, owners use a legal shield called a special purpose vehicle. If a wealthy investor owns 10 casinos, they do not own them under one massive corporate umbrella. Instead, they create 10 separate shell companies, often registered in tax havens like the Cayman Islands, Luxembourg, or Ireland. One company, one casino. Why? Because if a casino becomes worthless or faces legal liability, the rest of the portfolio is protected from creditors. But there's a massive problem lurking here. Let's say you borrow $1.5 billion to buy a $2 billion casino. A year later, the market crashes and the resale value drops to $800 million. You're now underwater on your loan. The collateral is worth less than the debt. The bank panics and demands cash immediately. If you can't pay, they seize the property. Casino history is littered with the corpses of over-leveraged companies that made exactly this mistake. Let's assume you managed the debt perfectly and never faced a margin call. You still face another enemy that's far more insidious: regulations. A casino physically lasts 30 to 50 years, but regulatory rules are constantly changing with alarming speed. Push to regulate gambling means sudden mandates for new security systems, responsible gambling programs, and anti-money laundering measures costing millions per property. Furthermore, what happens if you build a casino today that relies on international high rollers to find out in 10 years that new regulations restrict international gambling? Your casino becomes a stranded asset overnight. It's too expensive to operate, illegal in certain jurisdictions, and impossible to sell. Its $2 billion drops to near zero. Owners are constantly gambling on regulatory trends, political shifts, and geopolitical changes. Casino ownership rewards patience and heavily punishes overconfidence. Because of this volatility, casinos are traded just like volatile commodities on global markets. A mega resort bought for $2 billion might be worth $2.5 billion in a boom because tourists want to gamble today, or drop to $600 million in a crash. Some owners don't even intend to operate the casinos for their full lifespan. They speculate relentlessly, buy low, lease high, sell high. And when a casino finally reaches the end of its profitable life, it still holds value. It is either renovated and reopened under new management, or demolished and the land is sold for redevelopment. The owner is paid for the land value and any salvageable materials. Even in death, a large casino property might yield $100 to $500 million in land value, a final absolute floor to the asset's value. So why does this chaotic system work at all? For an operator like MGM Resorts, owning every casino in their portfolio is incredibly capital-intensive and debt-loaded. If global tourism slows down, an operator with 30 owned casinos still has to pay 30 mortgages, even if they're operating at minimal capacity. Leasing provides maximum flexibility. If demand drops, the operator simply lets their short-term leases expire and hands the properties back to the owners. The operator stays lean, the owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the casinos don't disappear. The owners simply take them back and recharter them to a competitor. The companies may die, but the casinos keep operating. The ecosystem adapts because casinos are valuable regardless of who operates them. But here's where it gets truly rigged and unfair to casino owners. Operators operate on razor-thin margins, typically 5 to 15% profit on revenues. Gaming revenue represents 40 to 60% of total revenue. When tourism drops, operators hemorrhage money and cut costs. When tourism booms, they profit and expand aggressively. But casino owners face a completely different problem. If tourism drops, operators reduce operations and return leased properties. If tourism booms, operators expand and demand more properties, driving up lease rates. Owners are constantly hedging against tourism volatility, a variable completely outside their control. A sudden geopolitical crisis that reduces international travel can bankrupt both operators and casino owners simultaneously. The casino development industry itself is rigged by design. Only a handful of major developers build mega resorts. MGM Resorts, Caesars Entertainment, Las Vegas Sands, and a few others. They control the entire supply chain completely. When you want to build a casino, you're not just buying a building. You're entering a multi-year contract with construction timelines that stretch a decade into the future. Prices fluctuate based on materials costs, labor availability, and demand cycles. You have no alternatives, no negotiating power, and you're locked into whatever terms the major developers dictate. During the 2008 financial crisis, investors that had ordered casinos for $2 billion suddenly found them worth $800 million before completion. They were forced to either accept massive losses or cancel orders and face severe penalties. The development oligopoly means you have no escape. Behind every casino you visit is a complex web of financial players you'll never see or know about. There are real estate investment trusts that own hundreds of properties. There are investment funds that buy casinos as diversification. There are pension funds from Scandinavian countries that own casinos as long-term assets. There are wealthy individuals from the Middle East and Asia who view casino ownership as a status symbol and investment vehicle. There are even casino brokers who buy and sell properties like commodities, taking a cut on every transaction. This hidden financial ecosystem is worth hundreds of billions of dollars, yet it operates almost entirely outside public awareness and scrutiny. Casino ownership is increasingly entangled with geopolitics in dangerous ways. When the U.S. imposed sanctions on certain countries, casinos that catered to those markets suddenly lost their primary customer base. When travel restrictions were implemented, international high rollers couldn't access casinos. Casinos became weapons in geopolitical conflicts, and owners found their assets frozen or worthless. Geopolitical tensions can instantly destroy the value of casino portfolios, a risk that's impossible to fully hedge against. Owners are at the mercy of government decisions they can't control. The lease agreements themselves are masterpieces of financial engineering designed to protect operators at the expense of casino owners. Operators negotiate clauses that allow them to return properties early if they become uneconomical. They negotiate maintenance reserves that shift the burden of aging properties onto owners. They negotiate residual value guarantees that protect them if property values collapse unexpectedly. Owners accept these terms because they're betting on long-term appreciation and lease income, but they're essentially betting against themselves. They're accepting downside risk in exchange for modest upside returns. Consider the economics of a typical casino lease carefully. An owner buys a $2 billion casino with $400 million of equity and $1.6 billion of bank financing. They lease it to an operator for $50 million per month. After 20 years, they've collected $12 billion in lease payments. They've paid off the $1.6 billion loan plus interest, roughly $2.4 billion total. They've paid maintenance reserves, insurance, and other costs, roughly $1.5 billion total. They've collected $12 billion in lease payments. Their net return is $12 billion minus $2.4 billion minus $1.5 billion equals $8.1 billion. They've made money, but wait, they still own the property. If it's worth $1 billion at the end of the lease, they gain an additional $1 billion. If it's worth $500 million, they lose $500 million. The entire return depends on the residual value of the property at the end of the lease, a variable that depends on tourism trends, regulations, technology, and geopolitics. It's a bet, not a sound investment. This is why casino owners are constantly monitoring market conditions, tourism patterns, and regulatory changes like hawks. They're not passive investors, they're active traders trying to time the market perfectly. Some owners buy casinos at the bottom of a crash cycle, lease them out, and sell them at the peak of a boom cycle, making generational wealth. Others buy at the peak, lease them out, and watch the market crash, losing everything. The difference between success and bankruptcy is often just timing and luck. It's a casino for sophisticated players with billions at stake. Now let's talk about the real money machine, the gaming operations themselves. The true genius of casino profitability lies not in the games themselves, but in the mathematical certainty of the house edge. Every single game in a casino is designed with a built-in advantage for the house. Slot machines have a house edge of 2 to 15%. Blackjack has a house edge of 0.5 to 4% depending on the rules. Roulette has a house edge of 2.7% on European wheels and 5.26% on American wheels. Craps has a house edge of 1.4% on pass line bets. Baccarat has a house edge of 1.06% on banker bets. These percentages might seem small, but when you multiply them across thousands of machines and tables operating 24 hours a day, 365 days a year, the numbers become astronomical. Let's do the math. A single slot machine generates approximately $300 per day in net revenue for the casino. A casino with 2,000 slot machines generates $600,000 per day just from slots. That's $219 million per year from a single revenue stream. A single blackjack table generates approximately $4,000 per day in net revenue. A casino with 100 blackjack tables generates $400,000 per day from tables. That's $146 million per year. A single roulette wheel generates approximately $2,000 per day. A casino with 50 roulette wheels generates $100,000 per day. That's $36.5 million per year. And this is just gaming revenue. The total gaming revenue for a major Las Vegas casino can exceed $500 million per year. But here's the secret that casinos don't want you to know. Gaming revenue is not the primary profit driver, it's actually the secondary profit driver. The primary profit driver is the total revenue from all sources combined. A major casino resort generates revenue from gaming, hotel rooms, restaurants, bars, nightclubs, theaters, shopping, conventions, and ancillary services. Gaming might represent 40 to 60% of total revenue, but it's not the most profitable segment. Hotel rooms have much higher profit margins. A hotel room that costs $50 to maintain per night can be sold for $200 to $500 per night. That's a 75 to 90% profit margin. Casino with 3,000 rooms operating at 90% occupancy generates $270 million in annual room revenue. With 80% profit margins, that's $216 million in annual room profit. Restaurants and bars have 60 to 70% profit margins. A casino with 10 restaurants and bars generating $100 million in annual revenue generates $60 to $70 million in annual profit. Nightclubs and entertainment venues have 50 to 60% profit margins. A casino with multiple nightclubs generating $50 million in annual revenue generates $25 to $30 million in annual profit. Shopping centers have 30 to 40% profit margin. Casino with shopping generating $30 million in annual revenue generates $9 to $12 million in annual profit. When you add it all up, a major casino resort generating $1 billion in total annual revenue might generate $400 to $500 million in annual profit. That's a 40 to 50% profit margin, which is extraordinary for any business. The real genius of casino profitability lies in the psychological manipulation of customers. Casinos employ teams of psychologists, behavioral economists, and data scientists to understand and exploit human behavior. Every aspect of the casino environment is scientifically designed to maximize spending. The layout of the casino floor is designed to maximize foot traffic past gaming machines and tables. The placement of slot machines is designed to create the illusion of winning. The sounds and lights of winning machines are designed to trigger dopamine release in the brain. The free drinks and snacks are designed to keep people at the tables longer. The comps and rewards programs are designed to create loyalty and repeat visits. The VIP programs are designed to identify high-value customers and provide them with personalized experiences that maximize their spending. The casino tracks every bet, every win, every loss, and every purchase. This data is analyzed to create detailed profiles of each customer. Casino knows your gambling preferences, your spending patterns, your favorite games, and your psychological triggers. This information is used to send you personalized offers designed to bring you back to the casino and maximize your spending. A high-value customer might receive a free suite, free meals, free show tickets, and free gambling chips, all designed to encourage them to return and spend more money. The secondary market for casino properties is where the true desperation shows clearly. When a casino reaches 20 to 30 years old, it becomes harder to lease to major operators because lessees prefer newer, more modern properties. Older casinos are sold to smaller operators, regional casinos, or international buyers at steep discounts. A casino that once leased for $50 million per month might be sold for $500 million to a smaller operator. The original owner takes a massive loss, but at least they get cash and eliminate the risk of the property becoming completely worthless. The secondary market is a dumping ground for properties that owners can no longer profitably operate. And then there's the ultimate endgame, casino demolition and redevelopment. When a casino reaches the end of its profitable life, it's either renovated and reopened under new management or demolished and the land is sold for redevelopment. The owner receives payment based on the land value and any salvageable materials. A casino property in Las Vegas might yield $100 to $500 million in land value, depending on the location. It's a pittance compared to the original $2 billion purchase price, but it's better than nothing. The casino that once generated hundreds of millions in annual revenue is reduced to raw land. Casino financing is the lifeblood of casino ownership, and it's incredibly complex. Real estate banks provide loans with complex covenants and restrictions. The loan amount depends on the property's age, condition, and earning potential. Interest rates depend on creditworthiness, market conditions, and tourism forecasts. If the bank believes tourism will decline, they demand higher interest rates. If they believe it will surge, they offer lower rates. Owners are gambling against banks on the direction of tourism demand. Most owners guess wrong and overpay for financing. The insurance markets for casinos are equally complex. A casino worth $2 billion needs insurance against fires, natural disasters, liability claims, and business interruption. Insurance premiums are based on the property's age, safety record, security measures, and location risk. Casinos in areas prone to earthquakes or hurricanes cost more to insure. Casinos with poor safety records cost more to insure. Insurance is another cost that directly impacts returns. Higher insurance costs mean lower profitability. Casino utilization rates directly determine profitability. If a casino operates at 90% occupancy with high gaming volume, it generates maximum revenue, but global demand for gambling fluctuates seasonally and cyclically. Summer tourism booms, winter tourism shrinks. Economic recessions reduce travel. Pandemics shut down casinos entirely. Utilization rates swing wildly, and casino owners suffer from low utilization. A casino that should generate $50 million per month in lease payments but only operates at 50% capacity generates just $25 million. The mortgage doesn't change. The entire system rewards operators and developers while punishing owners. It's designed this way intentionally. Casino developers want predictable demand and long contract terms. Operators want flexibility and minimal capital requirements. Banks want collateral and interest payments. Everyone else absorbs the risk. Casino owners are the margin providers who enable the system to function. Without owners willing to hold properties and accept the risk, operators would have to own everything and capital requirements would skyrocket. The system distributes risk in a way that incentivizes casino ownership despite its precarious nature. If you want to understand modern Las Vegas empires, you have to understand casino ownership. You have to understand how international investment firms control 30% of Las Vegas properties. You have to understand how pension funds pool money from ordinary citizens to buy casinos for retirement income. You have to understand how private equity firms use casino depreciation to generate returns. You have to understand that the casino you're visiting is ultimately owned by someone trying to generate returns by betting on tourism trends, regulations, technology, and economics. The system is rigged, but it's also efficient. It allows capital to flow to where it's most productive. The true secret of Las Vegas casino profitability is that it's not really about gambling at all. It's about creating an environment where people lose track of time, money, and reality. It's about exploiting human psychology and behavioral biases. It's about extracting maximum value from every single visitor through every possible revenue stream. It's about separating ownership from operation to spread risk and maximize returns. It's about using debt leverage to amplify returns on equity. It's about creating a system so complex and opaque that the average person can never understand how much money is actually being extracted from them. Casinos of Las Vegas generate tens of billions of dollars in annual revenue, but the vast majority of that money never reaches the people who actually gamble. It flows to owners, operators, developers, banks, and investors. People who lose money at the tables and machines are funding a system designed to extract their wealth as efficiently as possible. The lights, the sounds, the free drinks, the comps, the rewards programs, all of it is designed to keep you gambling longer and spending more money. The system is perfectly engineered to separate you from your money while making you feel like you're having fun. Consider subscribing to the channel and hitting the notification bell so you never miss another deep dive into how global markets really work. The truth about Las Vegas casino economics is far stranger and more sinister than fiction. The next time you visit a casino, remember that you're not just playing games. You're participating in one of the most sophisticated wealth extraction systems ever created. Every bet you place, every machine you play, every drink you consume, every room you book, every meal you eat, all of it is part of a carefully engineered system designed to maximize the wealth of people you'll never meet. The house always wins, not because of luck, but because the entire system is designed to ensure it.